Hi everyone, thanks for tuning into my channel. This is Sandeep Anand. World's most profitable company, Berkshire Hathaway, owned by Warren Buffett and Charlie Munger, is at pretty much an inflection point. It's the most profitable company in the world, which clocked around 20, in 2019, it clocked around $84 billion, and it's currently available at a cheap bargain. And it's at an inflection point, which the market is underpricing for whatever reason. And I thought I'll bring this to my audience attention. Take a look at this analysis. So this is a presentation. Before I start, a small disclaimer, like uh, none of the stocks discussed are held by me, or these are not stock recommendations. These are just purely for analysis purpose, and it should not be considered as a recommendation for stock buying or selling. Now, moving to the first slide, you could see that how this tectonic shift is happening from Berkshire Hathaway's holdings towards more tech heavy and asset light models from industrial and economic stocks. You could see that this has been happening over years and it's gaining more pace. And so you see that 46% is pertaining to these kind of business models, which is primarily Apple, 43% of their holdings, Amazon, a significant portion, StoneCo and Paytm, the other being the other payment giants, was StoneCo in Latin America and Paytm in India. Now, 54% is still is held in the old economy stocks, primarily with banking and energy stocks, and they sold off all the airline stocks in the last quarter. Now they made a loss of $47 billion in last quarter Q1, and profits of $26 billion in Q2. So which means that an 86% upside Q on Q, and that's an interesting increase in sales. Now, what has led to this? Apple. This is interesting. Apple itself added 26 billion towards the earnings in Q2 for Berkshire Hathaway, and they made profits of $84 billion approximately in 2019. They could well be at the same run rate this year. It could be even $90 billion, and with the way Apple's earnings are growing and stock returns are there, Berkshire could very well be looking at around 80 to $90 billion in FY20. Now, what's happening interesting is that their future earnings is looking more predictable in terms of cash flows with the kind of holdings they have. And why I think they are at an inflection point is, and the stock price is so cheap, and it's a bargain, and it's most ignored stock probably, is because they hold 48 50% of tech stocks, and which are pretty much dominant in the industries, asset light, and they have cash of $137 billion. They had around $142 billion. They bought back $5 billion shares in this quarter, and they have a market cap of around $509 billion. EPS in Q2 was $16,314 per share, Class A share. Now, if you just look at FY19 earnings of Berkshire Hathaway, which was $84 billion, and if you remove the cash, they are trading roughly at $4 billion, 4 times earnings. Sorry, and interestingly, that could be the earnings potential in the FY22, and that's pretty cheap for the earning potential. And there could be other influencing factor. There could be other tailwinds for Berkshire Hathaway returns. The reasons being, they bought heavily shares during the tough times. They bought energy stocks the last 3 4 months. They bought bank stocks, heavily loaded on Bank of America and all of the JP Morgans and of the world. And then they had railroad stocks. All are beaten down names in these tough times, and there could be strong recovery, which can be leading to the rebound in the and re-rating potential. And also they bought back shares which might not move the needle. It was only $5 billion, and earnings were depressed during the current quarters for all these old economy stocks and industrial stocks. And there could be a significant rebound, potential rebound, that can happen to these old economy stocks in the coming couple of the coming quarters or coming fiscal years. And that could re-rate the stock like anything. Plus Apple's predictable earnings, it's continuing to grow 10 11% with 5G and all. Apple's returns are going to be even better. So Berkshire Hathaway, the world's most profitable firm, could be the most ignored firm or most ignored stock from a return standpoint. So this is how sometimes market underprice the future earnings potential due to whatever reasons is. And I really feel Berkshire is at an inflection point from a shareholder return standpoint. Let's wait and watch. And as I said, there's not a recommendation, it's just an analysis purpose of how sometimes markets underprice even the most profitable company in the world. Hope you enjoy this video. Thanks for staying with me, and do subscribe if you like more such analysis videos.